Welcome to Illuminati Silver. We tell the truth about silver. Today is Saturday the 30th of October 2021. And earlier today we published our Gold and Silver Weekly Update, and we place a link to this in the description box below if you haven't been notified by YouTube of its existence or had an opportunity to at least listen to it. Now in that update we highlighted the fact that next week, this coming week, we see a plethora of critical financial and economic data coming out of the United States, and the all-important FOMC interest rate decision, and following statement by Fed Chair Jerome Powell on Wednesday. The issue that traders will be attempting to assess is when will the bond buying tapering begin? Will it be November or December? Or will the central bank leave it open, which we feel is extremely unlikely? Then, more important, they will be listening as to when the central bank believes that interest rates will rise, with some economists now predicting there could be a rate rise by the middle of 2022, many months sooner than originally estimated, primarily due to inflation exceeding expectations. Let's take a brief look, therefore, at 3 articles now dealing with this issue, because if the Fed is hawkish this week, we shall see a further strengthening of the US dollar, with the index now above 94, and this will act as a headwind for gold and silver prices. And if they're dovish, then their words are likely to result in tailwinds for gold and silver, assisting their rise. Let's take a look. Okay, so let's briefly take a look at this Bloomberg article published 30th of October. Goldman now sees Fed hiking rates in July as inflation lingers. Goldman Sachs Group economists said they now expect inflation will force the Federal Reserve to hike interest rates next July, a year earlier than previously expected. In a report to clients late on Friday, economists led by Jan Hatzius said the Fed will raise its benchmark from a range of 0 to 0.25% soon after it stops tapering its massive asset purchase program. A second increase will follow in November 2022. And the central bank will then raise rates 2 times a year after that, they said. Now this is important because we have to weigh this against the backdrop of the Fed originally claiming that inflation was transitory. And we have seen, A, according to the government figures, that inflation has been rising, and B, in the real world, that prices have gone up. The energy supply squeeze around the world and the shortages of staff in many industries, causing a number of backlogs, combined with the COVID-19 pandemic lockdowns, have all contributed to one extent or another to the raising of inflation, and not least, of course, being the high levels of money printing which governments across the world have adopted in order to see our way through a COVID-related recession. And that's their words, not ours. Fed Chair Jerome Powell and colleagues are predicted to announce next week, and now this is going to be on Wednesday, that they will start slowing their buying of assets in November or December at a pace of around $15 billion a month. While policymakers have previously been divided over whether they expect to start raising rates in 2022 or 2023, investors have stepped up bets in recent weeks that inflation will force their hand next year. And this is what perhaps most people are beginning to believe now. The Goldman economists said the main reason for their new forecast was they now expect inflation to prove more stubborn than they previously thought. They now expect consumer price inflation outside of food and energy costs to still be above 4% when the taper ends. The report quotes, "We think this will make a seamless move from tapering to rate hikes, the path of least resistance." We have to bear in mind that we also need to take an international approach. And Christine Lagarde of the European Central Bank last Thursday gave a relatively dovish statement and prognosis, and yet the markets did not believe her and tend to adopt the view that rates there too will have to rise much sooner than the bank is predicting. And we have seen in the United Kingdom, for example, the Bank of England already hinting that interest rate rises are coming very soon. The Fed has goals for both inflation and employment. While the Fed has said it wants maximum employment before increasing rates, Hatzius and his colleagues said with inflation far above target and job availability high, officials will likely conclude most of any remaining labour force weakness is structural or voluntary. Let's take a quick look at a very brief section of The Times Money Mentor. The Times is a major publication in the United Kingdom, one of the more serious publications, but with a right-wing bent. And it talks about interest rate rises for the UK. Because as we've already mentioned, the ECB, the United Kingdom, the USA, and then other countries such as China, of course, Australia, New Zealand, to a much lesser degree, Russia, India has an impact. All have some significance, including Switzerland, but maybe on the periphery, have some significance in terms of interest rate decisions, many of whom, certainly in the Western world, appear to be acting very closely together. And this is what Money Mentor says. Will interest rates rise in 2021? It's becoming more likely that rates will increase in December this year. This is for the UK now. This is because the Bank of England expects inflation to head above 4% by the end of 2021. Higher energy, fuel, transport and food costs make a rise in interest rates more likely. Investors are increasing their bets on a UK interest rate rise at the next MPC meeting, that's Monetary Policy Committee, meeting in December. Government bond yields are rising. One aspect holding the Bank of England back on a rise through fear of choking off a recovery might be the recent slowdown in the growth of the UK economy. The central bank's job is to keep inflation in check, and it can do this by altering interest rates. It aims for a healthy inflation rate of 2%. Now we know when we say about cooperation of Western governments, virtually all of them have come out with this magic figure. When rates are low, inflation tends to rise, and when rates are high, inflation tends to fall. So if the central bank increases interest rates, inflation should fall. Now that's a relatively simplistic view of how the economy works, but nevertheless it's broadly accurate. And for the Times Money Mentor to come out claiming that they are expecting rates to rise in the UK, we're already seeing, as mentioned earlier, in the Eurozone, the markets disbelieving Christine Lagarde and therefore pushing some of the rates up naturally. It comes to reason that the Fed, when they meet on Tuesday and then make their announcement on Wednesday of this coming week, are at least likely to start their bond tapering program as a prelude to raising rates. And as a last look at interest rates, we can see through FX Empire this very useful chart. October 29th, Colombia hikes interest rates by 50 basis points. 28th, Zimbabwe lifts its key interest rate to 60%. Same day, Egypt keeps rates steady. ECB leaves monetary policy unchanged as expected. ECB to maintain dovish stance despite price pressure. And Japan holds rates, cuts GDP growth. And on the 27th, Brazil delivers the largest rate hike since 2002. As we can see, the general sentiment is that the central bank has to act, and soon. We expressed in our update what we believe would happen, and we reiterate it here, that the Fed cannot enable inflation to continue to rise unchecked. At the same time, it does not wish to repeat its performance of a few years ago when it spooked equity markets at the end of the year, causing it to reverse course. This is why the language used on Wednesday will be so critical. Either way, we expect to see gold and silver prices move next week, which should bring some excitement into this space. What do you think the Fed will do on Wednesday? Do share your thoughts. And before we go, we're going to reproduce this video again tomorrow under a different thumbnail, as we will also do with the weekly update. We shall, however, make it very clear early in the video that it is a duplication, so that you do not waste any unnecessary time watching it. Thank you so much for listening. Please give us thumbs up, thumbs down, subscribe, press the bell sign. Have a great weekend. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.